Good morning. Good morning, everyone, and thank you for tuning in to our industry expert forum this morning. I think we can all agree in an industry that is constantly evolving, it's important to encourage dialogue, collaborate, and share expertise. We're thrilled today to have such an esteemed panel in the studio with representation from both national and provincial organizations, the media, and various brokerage companies. I think today's panel offers a diverse overview of some of the challenges we face in the industry today. Today we have Jim Murphy, President and CEO of CAAMP, Rob McLister of Canadian Mortgage Trends, Mark Kerzner, President of TMG, and Jared Dreyer, President of MBABC and owner of Verico Dreyer Group Mortgages. The format for today's panel will be quite straightforward. I'll pose each question to two of the panelists. After they've responded, if any of the panelists would like to add something or share an alternative viewpoint, you'll have an opportunity at that point. Also, for those viewers that are tuning in, there's a question box on your left-hand side. You can type your question in and I'll receive it on my iPad here. Good morning, gentlemen.
Hello.
Thank you for joining us.
Good morning, Dan.
So first I'll pose the first question to Jim and Jared. I will start with the two of you. In April, Minister Flaherty said specifically that he was not going to make any changes to mortgage regulations. And then in June, he announced a new set of changes to our surprise. Do you think this is the last of the government intervention? What about the new OSFI regulation on financial institutions? Do you expect more from the FI regulator?
Go ahead, Jim.
Appreciate it. We're cooperating already. I think his comment in March or April was based on the fact that they thought interest rates were going to rise in June or in the fall. And in light of what's going on in Europe and other places around the world, obviously Governor Carney can't increase rates. So I think the people in Ottawa looked at the other side, which is concerned about debt levels, the regulatory side of housing, and they decided to bring in their fourth set of changes in terms of mortgage insurance rules. So it was a disappointment. We thought that the market was already slowing. It's certainly slowing here in BC. We're seeing numbers in Toronto that the market is slowing, and we didn't want to see the government overreach in terms of what they're doing. Is it the last set of changes that they'll make? They will always say, Ottawa will always say that they're monitoring the situation, they're monitoring debt levels, they're concerned about the increase of, the potential increase of rates and what that means for borrowers. So I think we have to keep an eye on all that. The other thing that I think is really important in this and often underplayed is just the exposure of the taxpayer and their concern in Ottawa about their financial guarantee of all these mortgages. So we'll have to keep an eye on it. We certainly hope not, and we'll continue as CAAMP and other associations to work with Ottawa.
Yeah, I mean, in my opinion, I think the government, stepped a little bit too far on the latest regulations. I think the amortization from 30 to 25 years was something that they went too far on. And I think, they're going to have to reevaluate that. And we're already seeing the President of Genworth looking at if interest rates rise, that they should be reevaluating that. And, so I don't think there's going to be much further because I do believe the markets are already slowing down in both major areas, and which in Toronto and Vancouver, which is what really the rules were in place for. They weren't really in place for the other major centers. They were in place because Toronto and Vancouver house prices were rising so dramatically on that part. But I don't see at this point in time any further changes going forward.
There aren't that many other things they can do.
Yeah, really.
Which is the one thing, and we've been fighting on, is the 10% down payment. So, there are people in Ottawa who want to move to that who are saying, 10, 15 years ago, that's where we were. And they would argue the housing market worked then. That would have a huge impact in places like Vancouver and Toronto, higher cost centers. It's something that we're adamantly opposed to. So aside from that, there's not a lot more that they can do. I mean, the low-hanging fruit's kind of been dealt with from their point of view. And just to pick up on Jared's point, the president of Genworth recently said the impact on the high-insured mortgage in terms of the impact of these changes is it's not 5%. When the government used 5% in terms of the impact of all these changes was the entire mortgage market, not necessarily the high ratio, which they're estimating to be about 15%. That hits first-time buyers the most, that hits brokers the most, and that's why we've got to continue to do what we're doing in Ottawa.
That's great. Now, ultimately, the price is paid by someone, and the impact is felt by someone. Mark, Rob, who do you think actually pays for this?
Well, there's two types of borrowers really. There's really strong borrowers and there's not so strong borrowers. So to the extent that the rules rein in the not so strong or the fringe borrowers or whoever that however you want to term them, that's a positive. no question. The other end of the spectrum, the people that are low risk, well qualified, those are the people where, you know, they didn't necessarily need these changes. Now they're losing options, financing options. And, you know, I think a lot of people forget that, you know, a 30 or 35 or 40-year amortization actually has value and utility. It's not necessarily just to buy a bigger house or, you know, use your money for non-productive purposes. You know, at any given time, there may be a better use of funds other than paying down your mortgage, whether it be, you know, starting a business or investing or paying your kids' education or what have you. So the people that are not a risk to the system have lost options. So to that extent, it's a negative. So that, yeah, that would be my view on that.
My concern's a little more on a macro level, which is this is seemingly targeted the first-time home buyers. Yet the first-time home buyers aren't necessarily the ones who are the habitual debtors out there. There were some studies that were done saying that it's the 45-year-old to 55-year-old age bucket that keeps borrowing and borrowing and borrowing. Their debt-to-income ratio could be 170, 180, as opposed to the average that we're all so worried about at the 150, 151 point. So if we're targeting the wrong people, and that could have some impact on demand, and we've seen some potential impacts in supply on the supply side of the market. I'm just worried that that could accelerate some price erosion in the marketplace. And I mean, yes, we don't want consumers using their houses as ATMs at the end of the day, but by the same point, the consumer's ability to tap into the equity in their house, so, you know, not just the first-time home buyers, has really contributed a lot to spending in the Canadian economy. 1/3 of all refinance dollars are used for renovations and home improvement. 1/3 approximately is used for consumer spending. So there's a lot of bigger items at play, and the concern is that with all these changes, which one of those changes could potentially cause a slowdown in the market, a slowdown in the economy, or a slowdown in home prices.
And I think that's a great point. Now, do you feel that they've, and any of you feel to jump in on this, but do you really feel that they've maybe have totally overstepped their reach and are really going to have to scale back on this?
Go ahead, Jared.
Yeah, the only thing I would say, I agree with the comment that they have overreached. And the reason that what they have overreached is what they've done is they forced the consumer, the good consumer, who can't refinance their house past 80% anymore, who are potentially on that side. So what they forced them to do is go out and get lines of credit and unsecured debt. And, you know, so the banks now are, you know, charging, you know, prime +3, prime +4, whatever on lines of credit, and consumers still going to borrow that money, but they're going to go out and pay it. So the bank's actually making more profitability and worse for the Consumer Act, and that's the whole thing. Versus, you know, refinancing their debt load if they have to do that in that position, and if they can afford to do it under the guidelines at a 2.99% rate.
Yeah, I think that's a good point. I mean, consumers consume, and heavy consumers consume heavily. So, you know, to think that because a consumer can't refinance that high interest debt, that they're going to slow down their spending. I mean, there's a correlation there. I mean, but there's definitely still going to be the credit growth to a large degree in that segment of the market.
I mean, we'll have to see. A lot of this is about time, and we were talking earlier just about our research at CAAMP that we do, and a lot of this you may not see till next spring. I mean, yes, we're going to go through a fall housing market, and then we're going to go through a spring market. So we'll have to see in the next 6 to 8 months what the overall impact is. I mean, the federal government's made other changes. They made some OSFI rule changes also. So it's more or less the cumulative effect of all of these changes. You know, lenders are very cognizant of all these. Obviously brokers and what the products they can offer. I think it'll take a bit of time. We are of the view that it will have a bigger impact than the government thinks it's going to have. We are going to start using that 15% number in terms of high ratio, first-time buyers, as opposed to the 5% number. But I think in some ways it's just the longer term we'll have to see. I think there's also a view in Ottawa that, and Flaherty has said this publicly, that mortgage insurance, if we go back to insured product, isn't necessarily for refinancing. Mortgage insurance is for the purchase of a home. And so he said that publicly on several different occasions. I think there's huge advantages to refinancing, obviously, in lines of credit and trying to consolidate higher price debt. But that's not necessarily a view shared in Ottawa, that mortgage insurance is something for the purchase of a property and not necessarily for the refinancing of a property. That's something we have to educate them on.
Well, I think you led perfectly into my next question here, which is what will be the impact? And maybe you and Rob want to chime in on this. what will we see over the next 12 to 24 months? And is there markets that could be of concern, or maybe there's markets that could be a huge opportunity for consumers or borrowers?
Well, I don't play roulette in casinos, and I don't predict home prices. I think your odds are just as good either way. But the fact is, the housing market has surprised us. We've had a series of rule changes now, and after every one, we're always wondering what the negative effect is going to be, and it turns out that home prices keep riding the up escalator. So to say that these latest round of changes are the final nail in the coffin, I think that would be a little bit too adventurous to say. At the same time, I think a lot of people now are starting to look at the balance of factors and thinking that they're negative, especially in markets where there's been a little bit of price weakness already. So looking further out, I think the most important question from a consumer standpoint is not necessarily where houses are going to be or how home prices are going to be in 18 to 24 months, but are you prepared for the worst case, whatever that may be? And the economists are looking at 10 to 15%, whatever the number may be. If you have to move or you have to upgrade in 3 or 4 years, how does that potential devaluation and impact on your equity affect your options at that point? So it's a hope for the best and prepare for the worst scenario, I think.
Yeah, as I say, I think it's the first-time buyer. So we've seen some of the reports that have been done in terms of the overall impact of the changes. What's missing in all of this is rising rates. So rising rates would look after a lot of the concerns that Ottawa has about debt and about prices and those sorts of things, and that's the missing ingredient in all this. And the Bank of Canada can increase rates while the U.S. is on the sidelines and the dollar is at or above par. So they regulate. And they regulate housing to try and put a damper on it. What we get to a stage, though, is not only the effect on the borrower, but the effect that real estate makes on the overall economy in Canada in terms of jobs and all the things that we do in terms of related to real estate, construction jobs, all those sorts of things. You don't want to put those at risk either by putting policies into place that would exacerbate already slowing situation.
Yeah, go ahead. The only thing I'd add to that, I think the key factor is employment. And Rob Carrigy wrote an article again this morning. That's what I view as, the key reason why Canada still has, housing prices are still where they're at, why everyone's doing it, is we have low unemployment and unemployment numbers. If people have jobs, they'll make mortgage payments, they'll make their lines of credits, they'll make their car payments. If they don't have jobs, then we have problems. And that's really why the U.S. is in trouble, and that's why, Europe's in trouble. It's jobs.
Yeah, and I think, to your point, we've seen a lot of FIs advertise you need to save more, right? Preparing for the worst. Moving along a little bit here, there's been a new topic that's sort of come up in recent weeks, but we've seen broker compensation come under some scrutiny. Mark, Jared, we'll start with the two of you. In your opinion, are brokers overpaid?
I'm gonna.
Glad you started with them on that one.
The quick answer is no. But what I find really interesting with that question, and I'm a fan of the blogosphere, and I wrote some comments on some of the changes, in the last couple of weeks. Really, why is this question even being asked? There's only two reasons why the question's either being asked. Is there's this perception that as brokers, we all make way too much money, and we're living the sweet life, and we're making more than the value of the work that we're doing, or two, that the cost of the lenders who are providing us with access to products and the ones paying us at the end of the day are losing money, that our cost is going way up. And there's this perception, and I think you actually wrote a story on this, and there was some comments on that. There's this perception that broker costs are out of control. At least there seems to me that perception. And as far as I recall, broker costs in and of itself aren't increasing in any of this ridiculous rapid sense. So it's important to compare our costs against the other channels. When you're comparing against the bank channels, you've got branch costs, you've got physical real estate, you've got marketing expenses, you've got benefits, you've got discounting, you've got all kinds of other expenses. When you fully load the costs, there's arguments that I've seen made that the broker cost in many respects is less. But even if it's not less, it's a variable cost. So it's a cost that the lenders are able to choose whether or not they want to drive that volume or not drive that volume. there are a lot of brokers out there in the marketplace. I think that truthfully, given the complexity of our job and with the changing guidelines that we've just covered off, with the lenders changing in the marketplace and the complexity of the types of deals that we're seeing now, we're seeing more complex deals, spending more time with consumers, counseling them more on suitability issues than ever before for the same pay that we've gotten in the past. So in my opinion, I think that brokers are fairly compensated and represent the best option for consumers.
Good points. I agree with you, Mark. I think, one of the key things is I've been doing this for 20 years, and, my commission has risen, has doubled from when I first started back in 1992. And, at that time. But the lenders were more efficient back in the 90s. And I think what you have to look at is it's not that we are the cheapest delivery channel for the lenders. I think the lenders have to look at their efficiencies. I think if you really look at where they can stream down, if they want to stream down basis point costs and everything, from my opinion, there's a lot of inefficiencies with how they underwrite, how they process the deal, everything that goes into that side of it. And I think they have to look at what their costs are related to it, because we're their cheapest distribution channel, period. And we provide the most volume for them at the least amount of cost to it. I think they have to look at their own operations.
Rob, it sounded like you had an opinion there.
A little one. I've before this panel, I talked to a couple banks and whatnot to try and gauge, what the costs are, because really, if you're asking if brokers are overpaid, then you have to compare them to something. So it's the lender's own direct sales channel. What do those guys cost the lender? And you talked about some of the factors and whatnot that play into it. It seems like no one really has a good answer to that. Everyone's done models, obviously, forever on it. But the number that I keep hearing in terms of an average is like 70, 75 basis points on a 5-year fixed for a lender direct rep, a road rep at a major bank or whatnot. So if that number is correct, and I don't know if it is, then if you're measuring brokers' compensation just against a number like that, then perhaps brokers are overpaid. I believe that the compensation between the broker channel and the direct sales channels will converge. I do strongly believe that compensation will go down in the broker industry. There's always going to be exceptions. There's a lot of lenders out there, there's a lot of competition, and there's going to be, at any given time, lenders that need to fund mortgages. And I think you probably see a reduction in compensation, but you're going to see also a lot of times special promotions. Fund a mortgage by October 31st and get an extra X basis points on your deal.
The other thing I'd comment on that, if you direct this to sales forces, the direct sales force people don't have the expenditures that brokers have. Like, brokers have to pay for their own E&O, their own insurance, their own marketing efforts. The sales force reps have no expenses. They get computers provided for them, training provided for them. They work out of their houses. Yeah. Computers are all provided for them. And so they're making a pure 75 basis points, like pure. We're not making that pure. Like, all our costs we have to split with the houses, with our brokerage companies. Then you got your advertising dollars, your marketing dollars. So you really look it down to it. Probably a broker, realistically in today's marketplace, is probably only making 65, 70 basis points after their net split to them.
Yeah. And someone has to pay those costs, right? And the banks are paying those extra costs, and you kind of have to look at the whole equation, right?
Yeah. I'd say two things. We're comparing ourselves to other segments in the lending channel. On an origination, I would compare us to other professions in a real estate transaction. So in relation to that, no. When you look at what some others in a real estate transaction are getting paid and the percentages and the service that they provide, I think a mortgage is pretty important in terms of closing and financing and the expertise and the product and the knowledge on all of that. So in that relation, no. I think, though, that everybody, including lenders, have to make a buck. Brokers have to make a buck. There's nothing wrong with profit. There's nothing wrong with making money. There's nothing wrong with trying to look at your costs. Everybody does in their business. We do that in our association world in terms of our costs and our expenditures. As per one of the recent announcements, there are we just talked about some government change as well. One of the things in Ottawa we didn't talk about was the fact that the government has capped portfolio insurance and access, which is very important for monoline lenders in terms of selling into the bond program. And if they can't do that, they've got to get their money elsewhere, they've got to get their capital elsewhere, and it's going to cost them more. So these are all things that are come together, and there are costs involved in that. But I think everybody has to make a buck. We'll see where things are in a couple of years. I mean, we all are aware of what happened in Australia 4 or 5 years ago in terms of a reduction. It's a very similar market to Canada. You have 4 major banks. They still maintain they're at 30 to 40% market share, the broker channel in Australia, but probably at 50 basis points. But then they're paid after that in terms of what happens to the deals that refinanced early. Was there fraud involved? Was there arrears involved? And so that's how the lenders have come in terms of the model. But I think everybody has to make a buck in the channel, and there are new costs that are coming in that weren't there before.
Just want to make 2 small points. One is that, yes, there are new costs coming in, but the spreads have widened considerably. 5 years ago, where the average spread might have been 126 basis points, now we're at about 175 to 185. And I wouldn't be surprised if we go to 200. And that spread differential covers a lot of the increase in costs. And there's increase in liquidity costs and in risk-weighted costs in a whole bunch of different expenses, of which the brokers are at cost. There's no doubt about it. The other thing that I think is indicative is the monolines are in business strictly for the purpose of originating and then aggregating mortgages. And so when I look at it, they're a good indicator of what costs a broker should be, because they're not comparing it to a direct cost. They're comparing it, you're right, everyone in the chain has to be able to make some profit. The agent, the brokerage, the lender, everyone. So if we're in a cost structure that's comfortable for the monolines to compete, that would indicate to me that the relative cost of us and our channel is appropriate.
And I think the other thing too is, I mean, you can't just look at the compensation number. You have to look at the other factors like retention, things like that, cross-sell, right? And to figure out what value the brokers add for the lender. And I think that over time, we're going to see more lenders implement direct-to-consumer strategies. I have a funny feeling that in time, ING will go that route. And when that happens, if you start seeing more direct-to-consumer models, I think you're going to see an impact on broker compensation.
The other thing I would add to that is everyone's saying, if you look at the U.S. model, the U.S. model had a 70% market share, right, Jim, at its peak. Went down to, 12% probably right now? Right, that side?
Pretty significant
Pretty
drop.
significant drop last 5 years, okay. I would go to a coaching group down in the States and meet with the brokers down there. And the brokers in the U.S. right now are getting paid between $175 and $250 per term on any type of their mortgages. And they are, the brokers that are left there, the lenders, partners are way more efficient. They're making more money than they ever did in the peak boom, the people that are left. So I think what we really have to look at is that there's a situation where lenders got out of the marketplace, the broker became the bad favor, but efficiencies got put into place. And this is where I'm saying that the lenders have to look at their own efficiencies. And I believe the same as you, Mark, there's way more room for compensation for brokers because we are the best channel for them. But they are not looking at their efficiencies on how they can maximize their dollars out to make the most money for that.
Now, do you feel as though there may be an evolution sort of happening? Are we going to see maybe not a reduction, but a change? And any of you do you have an opinion on this?
Well, I think the middleman always gets squeezed in any business. Now, brokers are a different kind of middleman because we add advice and value, true, honest value to the mix. The question is, the price lenders are willing to pay for that value. There used to be,
The borrower is willing to pay for
yeah. Yeah, and there used to be travel agents making 15% every time they sold a hotel room. Okay, that doesn't happen anymore. So brokers' compensation is going to be under pressure from a number of fronts, and it's our job to be highly efficient and to prove, Jared right in terms of the best channel for lenders to distribute.
Yeah, and I mean we've seen the discussion around margins being squeezed. We've seen lenders having challenges or looking at exiting. We've seen First Line, the change in ING, Macquarie, Concentra. I mean, I was at Macquarie. I know the story all too well. Are there is there room for other lenders to come in, and is there room for other lenders to exit? I mean, is there lenders that are not running efficiently?
Dan, I think the points you make are very important. As Bob Dylan said, the times they are changing, and we're in a different we are in a different environment, and it is not business as usual. I mean, you know, I think we have to be honest with ourselves in terms of why lenders are leaving the channel. Whether it's because their parent company offshore, in the case of Macquarie, that can invest in a toll bridge in Tokyo and make a better return than mortgages in Red Deer. You know, these are things that we have to be, you know, cognizant of. There's reasons that these things happen. We certainly I meet with people. We try to encourage more lenders to come into the channel. We've had some good discussions. There's been a couple that have announced recently that have come into the channel. You know, I think it's good that you have large brands that are in the channel. Our research shows that consumers like that affinity, and we've been meeting with a couple to try to encourage them, talk about the benefits. I think I agree with what's been said here. It is kind of a partnership. There's got to be efficiencies that are offered. There's got to be professionalism that's offered. There is a service that is provided, a very good service. And all these changes we've talked about, I think, provides an opportunity also for the mortgage broker to say to the consumer, all these things, they're on top of it. I don't know if somebody in a branch that's been in the job for 2 weeks is necessarily on top of those changes and what the best advice is to offer to a borrower that comes in off the street. But there is a reason lenders are making decisions, and I think all brokers need to be aware of that and what the mindset is, and we certainly hope there's not more that leave the channel.
I just want to, build on that point too, which is competition in any industry is extremely important. It's important to the consumer at the end of the day. It can be reflective in what products are offered and what prices that they're able to obtain those products. It's important when we go back and talk about our compensation. It's important when we talk about our industry. So I'd hope, and I'm excited at the prospect that I know a number of people who are looking at entering the channel, and we've heard some announcements as you talked about and you covered off in Canadian Mortgage Trends that are coming into the channel. So I think that it's important to keep those lines of communication open with prospective people coming in. The other thing is, it's vital for brokers, and I just want to speak to brokers for a minute, that you value those relationships you have with your lenders. It's I talk about the fact that your customer is 1A, but your lender's got to be a really close 1B. They're the ones who pay us at the end of the day, and they're the ones who provide us with product. And there's all this talk about efficiency ratios or this or that. What does it mean to be a good partner? It means to have a good quality portfolio. It means to be responsive to their needs. It means to open the dialogue with them so that they can learn more about your business. But it's really important that as brokers, that we maintain these great partnerships with lenders. And the monoliners are very important for that. And the banks are very important. We can't go bash any lenders as an industry. We have to value each of those lenders. The one thing that worries me with the lenders leaving the channel is access to funding. So ING, they say it'll be business as usual, and I have no reason not to believe that. However, they're also a funder in our channel as well. And CIBC deciding to shut down First Line, that represents a certain amount of funding that goes into the channel. So my bigger concern is making sure that there's a lot of liquidity in our channel, that the investors are interested in purchasing the mortgage assets, and that's something that I think that we need to ensure stays robust in our channel.
Well, and the comment of business as usual, I think we've all heard that comment a few times now over the past few years, and every time it sort of is a concerning viewpoint from some of the institutions that choose to make that comment. Now, business as usual, volume bonus is sort of how a lot of the brokerages are paid. Do we see a move to more of an efficiency bonus, or is the dialogue open with the brokerages and the lenders to make changes on that front?
Well, as a brokerage, the problem that I have with efficiency bonus, volume bonus is very simple. Send me volume, I'll give you a bonus. Efficiency bonuses are calculated in all kinds of different ways. And as Jared was saying, the lenders have a part to play in that as well. And as our partners, we need to understand what makes them efficient, and they need to understand how we can contribute to that. In my opinion, there's 3 things that contribute to efficiency. 1 is pricing, 2 is service levels, and 3 is broker behavior. And you can interchange the order of that, but those are the 3 primary factors that would create efficiencies. So I'm not opposed to valuing a relationship on something other than strict dollars going in, but it's important for us to have dialogue with the lenders so that we can understand their business, so that they can understand how we do business most effectively. to come up with compensation that is fair. But I don't think it's altogether inappropriate to have some type of volume incentives. I see it in lots of businesses out there. You know, quite frankly, what we represent is distribution for lenders, and distribution is in the form of volume.
Yeah, I think sometimes lenders that have tried those kind of programs, it hasn't worked for them, you know, to try and get different type of models. And I don't think it's a model that's going to work for the future. I think it's a very, you know, sometimes the lenders try and get too complex when it's very, you're right, it's very simple. We're a distribution channel for them, and what they get paid on is volume. I mean, they just had record profits, the biggest profits ever, and all mortgage related, in lines of credit related products. So that's what they're looking for, that's what they want from us. Let's get more efficient. And of course, the broker, be a better broker. Like that's, if you want to do more business, become better. That's it. That's simple on that side. And you're right. Pick your partners and get your partners to become better with you.
Whenever there's change, there's opportunity. And so I think, yes, we're talking a lot about changes, whether the regulatory changes, whether there's changes about lenders that are in the channel, profitability, all of these things are at the fore right now. But whenever there's change, there's opportunity. And as Jared just said, a good broker will get out there, educate themselves, find out what's going on, and work with their lenders and partner with their lenders. And there could be a tremendous upside to that. It's not all doom and gloom.
Well, and I mean, and maybe Rob, you can key in on this, but at the end of the day, if you send more volume to a lender, you get better rates. At the end of the day, the consumer gets a better rate. So isn't that all great?
Yeah, and it kind of plays into one of the other questions about pooling. You know, lenders have increased compensation if an individual agent provides you know, good volume and efficiency and whatnot. And a lot of people are piggybacking off that by routing their deals up under one agent. And I think that's good and bad. I mean, we are in an industry, I think, where margins are only going to get tighter and tighter. You know, the spreads are wide now. I don't see that being a long-term trend. As the internet takes hold and there's increased competition and direct-to-consumer models come out, then I think the margins are going to shrink. And lenders are going to be looking at ways to improve their profitability. They're going to be looking at things like pooling. And like I said, pooling is good and bad. Bad for lenders if they don't get the efficiencies that they need. Good for brokers overall, even if you're routing up through someone else, because it gives you the opportunity to compete with, you know, the banks and the credit unions and whatnot that are getting more competitive every day. So if you can't offer the consumer choice and you can't route these deals up through someone else and benefit from pooling and better compensation, then it's a negative for a lot of brokers. And if you have consumers going to brokers and they're not getting the best pricing or the best value, it's a negative overall for the industry. So it's, you know, probably the answer, and I'm sure you'll talk about this in a bit, the answer to all of it is probably a type of hub model where you send up through one person. And that one person is responsible for the efficiency ratios and the approvals, and the lender only has to deal with that one individual, as opposed to dealing with, you know, multiple individuals and losing the efficiency.
Yeah. And I mean, we're getting a bunch of commentary of it from online, and I appreciate that from everyone. And one of that keeps coming in, pooling, and who really benefits, who really is impacted by it. And do you think that as a result of this, are we going to see a lot more consolidation, whether it's, you know, joining together and creating a larger brokerage, or joining the likes of Dominion or Verico or TMG or Mortgage Architects or whoever?
You're talking, sorry.
I guess I'll start off. You know,
Sorry, Jared.
Pooling in my aspect is, I don't see where the problem with pooling is from the lender's perspective, okay? And from what's happened with pooling, and where, you know, there's definitely people, there's a camp out there that feel First Line went under because of pooling. The First National thing is because of pooling, you know, and that sort of thing. And definitely I agree with that. But the reality is the lenders know who's pooling and who's efficient with them. Mm-hmm. So I don't know why they don't make a change to say, okay, you know what? You got 250 people under you. You're funding 38%. We're not going to deal with you anymore. Mm-hmm. It's not happening. You know, lenders need to step up and say, you know what, That type of pooling doesn't work. But if you're a brokerage house that has 30 or 40 brokers, you have an underwriting center like a hub like you're talking about, and you're funding 75, 80% of every production coming out, you're an efficient business model to them. So the lenders need to make their choices now on realistically getting rid of the inefficient business models and telling them, we're not going to work with you, become efficient. And that's where they have to make their changes.
I see pooling as a bit of a loaded question because it means different things to different people, different companies and different brokers and different lenders. And I'll be nostalgic for a minute. You know, many people know I spent a lot of time running sales and marketing at FirstLine. I left there 6 years ago. And we always reviewed the volume bonus structure on an annual basis, and some of our competitors went to an individual volume bonus structure while we still, at the time, maintained a corporate volume bonus structure. And that really started pooling when you go to an individual and then you need a group of individuals to go underneath. The one thing that I think we need to keep in mind here is a consumer at the end of the day. Another reason why this pooling took place is because lenders became selective with which brokers they dealt with. Keep in mind that one of the best broker value propositions going back a number of years was access to choice. It wasn't just FirstLine and TD who were the two lenders, the mainstream lenders offering choice to brokers. You know, having access to a bunch of different lenders is important to the consumer. If you're a broker and you're 2 years into the business and you're doing $5 to $7 million, but you only have access to two lenders, then you don't have access to the same choice for your consumer at the end of the day. So having access to, we call it pooling, you know, that's what the industry has rallied around, this pooling label, is important for consumers at the end of the day as long as it's managed effectively. And that's where I think it can be win-win for everyone. The lenders can make a fair profit, they can demand the efficiencies and the process that they require, the brokers can benefit by rallying together. I think there's one other misconception, and Rob, I may have interpreted one of your comments incorrectly, that brokers may be better off if there wasn't pooling. There's a misconception that without pooling, all the brokers will have access to the lowest rates. And I don't think that, that's not what you were saying, but that's something that I've been reading on some of the blogs. We got to do away with pooling because it's not fair that only some people have access to these lower rates. And I don't think that's necessarily the case either. So to have the opportunities for pooling gives the consumers good rates, gives the lenders predictable volume and distribution. And so I think we need to manage it effectively.
I agree totally. And you know, if pooling is efficient, it's a benefit, a big benefit to the broker industry. Because again, if you can't offer that choice, then you're competing against brands like RBC and TD and BMO, and you can't win that battle. Right. You need to offer that choice and the value and the rates and whatnot, and pooling is a big factor behind that.
I agree with everything that's been said. I was trying to get in there early. I agree with Jared about the hub. At the end of the day, it's whose name it's under is responsible for it, in my view. But it's got to be managed properly. I went through a center in Montreal that Multiprey has, and I was very impressed by it. It was a hub. And the calls that come in, and who's managing it, and how it's managed, and just, you know, all the rates from all the lenders there. It was a very good operation. It really was. So I agree with Mark's comments about how you have to manage it. It is obviously a benefit because not all brokers have access, so it has to be done properly. And that, I think, would be what lenders would ask. They would ask that it be managed properly. They want to know, you know, who is putting in the deal. So I think at the end of the day, there has to be responsibility, and I agree with Rob that it's got to be the person whose name it's under.
I agree.
And I don't mean to beat a dead horse here, so maybe we'll move a little bit away from the pooling. But I guess kind of to your point, Mark, is that we're seeing a lot of commentary on the blog space, whether it's actual blogs, whether it's comments on blogs, just negativity about the industry. And I'm not that negative, but is it an industry-wide viewpoint that's out there, or is it just a select few individuals? Maybe Rob, I mean, you're in touch.
Well, in terms of negativity against the industry, I don't really get that part of it. You know, I think that brokers, again, add obvious value. I mean, you're going to have an option when you're getting a mortgage, and it's to walk into a branch or deal with a mortgage specialist that deals only with one lender, that can tell you only the options from one institution, versus someone that theoretically is well-versed in multiple lenders' products and can give you a product that may have better terms, fewer restrictions that cost you money down the road. So there's a big benefit as a consumer in dealing with someone that can give you choice, because it is absolutely not about the rate up front. Okay, that's just one number. The overall borrowing cost is the key factor to consider. And at any given time, maybe you walk into the right lender, you happen to walk into the right lender, and they have the truly best product for you. In my opinion, that happens, maybe 1 out of 10 times or less.
It used to be that brokers were the lenders of last resort, second mortgages. That changed. We're now going through another phase we've talked about in terms of lenders exiting the channel. I think we compare ourselves to realtors and insurance brokers, which are the two professions that are similar. Both of them have protection. Both of them have regulatory protection. So we know what's going on with the Competition Tribunal and the MLS system in realtors, and insurance brokers have in the Bank Act that banks can't sell insurance in branches. Brokers have none of those protections, and yet they have gotten to 25 to 30% market share, higher for first-time buyers, which is really phenomenal. People working hard, people representing the interests of borrowers to get them the best deal, to offer them advice, to offer them professional advice in terms of the products and what's in their best interests in making the largest financial contribution of their lifetime. So I think brokers have done exceedingly well to get to where they are without those protections in place, to take on the 5 or 6 largest financial institutions and to get to where they are. There's obviously a niche there, and that has worked. But we are in different times. We have been obviously since 2008, and we have to accommodate that, and we have to deal with that reality. We have to sell the advantages of the broker channel. We've talked about that this morning in terms of the great things that the channel does, and both the relationship between brokers and lenders, but also to make sure that borrowers continue to see the advantage. Because most borrowers think that a broker is working on their behalf, that they can shop the market, that they can come with different things. And yes, price isn't everything. There are other things, and a good broker will offer those other advice, and not just rate.
And maybe I'll touch on this a little bit, but you said this idea of get better, and Jared mentioned this as well, but what can a broker do to be better? Is it, offer more products, really the consultation process? Maybe Jared, you had a little bit of a point on that.
Well, the broker needs to learn their craft. I mean, to start off with, you need to know how to talk to a client. You need to know how to present options. I know that probably a majority of brokers out there are still order takers, and that's why you get this rate buy downs and everything on that side, because they're not offering the client what they're coming to. And the key thing is they're not asking the question to the client, well, why do you want this mortgage? Why are you buying this house? What's your long-term plans? What's your benefit to doing that? So you want to go 5-year term. Well, why? Have you looked at other options? And so they're not coming from an advisory role. They're doing an order-taking role. So in those order-taking roles, you're going to get crushed on buy downs and everything on that side if you're just competing on rate. If you don't differentiate yourself from the broker, from the branch community, from everything else, you're not going to win anymore. So you got to become better. So you should be practicing scripts. You should be learning how to different dialogues. You should be going to coaching. All those things, and it never ends. I mean, I've been doing it, like I said, 20 years. I still have a coach. I still go every quarter to a seminar to make sure to learn myself better. So, invest in yourself.
Yeah, one thing I'll just add to that is surround yourself with great people and knowledgeable people, whether it's mentorships, whether it's working with a broker or a mentor or someone who can help you, whether it's having access to a hub, but not a hub who will just take your deal, but a hub who will walk you through and educate you about that and talk to you about the process. Surround yourself with great people and believe in what you're doing that adds benefit to the consumer, because it does. And you touched on something before, a mortgage specialist has access to one product, and that might be the best product in some cases for the consumer, but if you compare that to the branch employee who has to be trained on hundreds of different products and may not have the same experience, and you touched on before, Jim, that they don't have the same licensing requirements as brokers. I mean, there's no doubt about it that a broker represents the best interest for a consumer at the end of the day. But as an industry, we have to believe that as well. And back to the original question, which, we talked about the negativity. There does seem to be some negativity in some of the blogosphere out there, and the consumers have access to that. They watch the comments, they follow it. As an industry, we need to be positive about our industry. and we need to be constructive about it.
You know, in the United States, when the mortgage meltdown happened, everybody blamed brokers. They weren't educated, they weren't licensed in the U.S., they didn't have to have education requirements. There was a stat out of Ohio that 10% of all the mortgage brokers in that state had a criminal record. I mean, there were all of these things out there that were just hammered on in the media. That hasn't happened here. I think brokers, as I said earlier, are seen in a positive light. The interesting thing that's happened here is there seems to be a lot of media attention on mortgage insurers, particularly CMHC, and what they're doing and what their products are and what their exposure is. And I think mortgage insurance has really played a positive role in the Canadian mortgage market overall. I think it differentiates us in terms of our mortgage market versus other countries. I think it's been very helpful to us. But it's interesting in terms of the media and the commentary. It hasn't, unlike the US, it hasn't been focused on the broker channel, not to say that there aren't the challenges that we've been talking about. But there's been a lot of media about mortgage insurers and what is their exposure and what are their products. And I think they're very good products, and they've served the Canadian market and the Canadian home buyer very well. But it's interesting how the media kind of goes in packs and has all these stories and does these sorts of things. I think mortgage brokers have been a great source of information. I mean, we've tried at CAAMP through our research and what we do in our media. I know Rob's now got a column in the Globe and all these things. I mean, brokers are seen to be areas of expertise in terms of the media. I mean, the day of Minister Flaherty's announcement, got 15 calls from the media. We don't even have to send out a release anymore in terms of when you're positioned that way to be seen as the experts or to be seen as the source of information. That takes time to do, but I think brokers are seen in a positive light in that regard. Not to say that there aren't challenges from time to time, but that's all part of our role to educate.
Yeah, I'll just jump in with one last point. You asked, what can brokers do to add more value to consumers? And I think the answer, in large part, is to know more. So, Jared talked about many brokers are turning into order takers now, just trying to get that next deal in the pipeline. I think there's an interesting dynamic here because, I mean, you have to invest in yourself and spend a lot of time to really be an expert, a mortgage expert, and to be able to tell people with confidence what is the right mortgage term. Anyone can find the easiest, the lowest mortgage rate. But to know which lender has the least restrictions, the most flexibility, the best overall value, that takes a lot of work, and it's very difficult to do. And there's, like I said, there's an interesting dynamic though, because you have the internet now and you have these rate aggregation sites and you have people starting with the interest rate as the #1 research factor when they're looking for a mortgage. And I think that you're going to have more and more people trying to compete on rate, and it's a slippery slope because when you do that, there's less revenue per deal, and the incentive to really spend a lot of time on research and to perfect your mortgage advisory skills, the incentive to do that goes down. So that's one thing that I'm kind of worried about.
So, I mean, to sort of paraphrase, but we're worried about the lenders reducing our compensation, but we're reducing our own.
It's happening, yeah. I mean, compensation is never going to go back up. It's on, in my opinion, a one-way street. It might take a while. It might be, a slow process. But I would not be shocked in 5 years from now to see people in our industry getting paid, 25, 30%, 40% less on, the typical mortgage.
And I mean, that kind of brings me to a next point. And some of these I'm sort of pulling from people's questions online. And, there's a lot of brokers out there. Do you think, are we going to see more people leaving, more people entering? And I mean, what are your viewpoints? And maybe there's different segments that are different ways.
The number of licensed mortgage brokers across the country has been stable the last 2 or 3 years. Ontario went through relicensing last March. There was a drop of 18%. Some of that has come back. Alberta is going through licensing right now by the end of the month, and that's a province that has the strongest economy in the country in terms of their GDP growth. I think you're going to see something very stable in terms of the number of licensees in Alberta. So we probably have 16,000 to 18,000 licensed across the country, but there isn't the growth. And many people in the industry think that's a good thing, and perhaps that there are too many. But I think that's also a reflection of what we've been talking about. And so people talk about what are the barriers or the obstacles to entry. A lot of people want to make things tougher, whether it's in terms of licensing, whether it's in terms of education, whether it's in terms of the fees that you pay. and as a theme of this morning, to build professionalism within the industry. By the same token, you also want to build the industry, so you want new people coming into the industry. You want people to see it as a career, and you want to support those people in terms of all the things that have been talked about. So I think the growth in the channel has stalled. It's stayed the same. We haven't had increases in the number of licensees across the country. You have pockets here and there, like in a province like Saskatchewan, which has got a very strong economy where the broker channel wasn't developed. You've seen in percentage numbers a significant increase, in absolute numbers not a huge increase.
To me, it's actually an indication of how confident people are in our market. People come into a market if they perceive that there's opportunities. So all the growth in our channel, the number of agents who have come in because they perceive that there's a lot of opportunities, and the value we represent to consumers is a strong value proposition. So I know there's people out there who feel that the number needs to go down, there needs to be a culling. My concern is that if the number starts to drop, that'll be a reflection on the market itself, whether it's the resale activity, number of mortgage opportunities, whatever you have it. So I just think, to your point, Jim, we need the right people in the industry. We still need to encourage new people to enter the industry. Otherwise, we're just going to become a stale group who's not in touch with the consumer. So, I want to make sure that our industry remains vibrant, that there are new people coming in. And I'm hoping the number doesn't drop because of the market forces. I hope it drops because the right people want to stay in the market and serve the needs of consumers.
I think the market is going to drop in brokers, and I think from the broker perspective, I look at our industry. If I want to look at any industry, I think we want to become like what financial advisors are, like the Wood Gundys, the TD Waterhouse guys that they went through the mutual fund industry that went through 10 years ago, where they had a complete flushing out of the system, and the people that were left in the system have done exceptionally well. And if you want to get into the system, you're basically on a 2 to 3 year apprentice program under somebody. And I think that's how mortgaging's got to go. If I have my wish list, it'd be more like the mutual fund industry, not like the insurance industry or the real estate industry. I think we're a professional organization. The only way you can do that is if you raise the bar of education, you raise the bar of requirements to get in, and everyone gets better on it. And I think the lenders have a real opportunity, because especially all the banks own, essentially all the mutual fund companies out there anyways. They can create that model already exists for them, and they can do that as an ongoing revenue stream for the next 15, 20 years, where you're getting paid for 20 years on a mortgage revenue, if you do it properly and efficiently.
I think there's another interesting phenomenon here too. The people are starting with the internet routinely now to start their mortgage research, and the people in the top 10 or 20 listings on Google are going to increasingly get a disproportionate amount of mortgage business. And there's some really powerful brands, I think, forming slowly in our business. I'm talking about brokerages and individuals that are online marketing strongly. Those people are going to get a disproportionate amount of the business, and especially since they're generally higher volume producers, and there's benefits in dealing with a higher volume broker in terms of pricing and some other things. So you might see some pressure on independent mortgage agents, the standalone guys with the little storefront someplace. I think long term it's going to be a bit harder for those people to compete when people start shifting a bit more to the internet. And you already have, like 3 out of 10 people doing all of their mortgage research online. So it's an interesting dynamic.
And you talk a little bit about the internet, and we'll end with this question here. But I feel this is probably a good question for all of you. But what is the best channel? What shall we do to really, push out our message together as an industry, not as segregated portions or one website or one brokerage, but what can we do to have more of a collaborative approach to getting the right message out to our consumers?
Well, I would say that CAAMP is doing a tremendous job in terms of kind of marketing our value to people. And that's, I think, what's required, because I think Maritz had some numbers in terms of how many consumers actually truly understand what we do. So we need to kind of come together as an industry and focus resources and pick a lead horse to kind of market our message to people. And I think CAAMP is as good as any to do that.
Thank you, Rob.
My pleasure. It's an unsolicited comment.
Did not have breakfast.
Go ahead, Jim.
I mean, I think there's two things there. There's obviously what we can do to assist brokers to become better and more knowledgeable, and the research that research is expensive. Merritt's does a lot of good work for us. We do a lot of reports that hopefully every broker, everybody who's watching today, goes through, because there's a lot of really good information in there that can help them in terms of their daily business. And then there's the other aspect, which is the relationship to the borrower, to the consumer. And we all need to focus on that also. We do a bit of that, obviously, through our AMP. We talk about professionalism, raising the bar, and differentiating. And we'll be looking at it again as part of our strategic plan to make it even more broker-focused. So there's only so many resources that go around. And I think one of the differences between the Canadian market and the Australian market, for example, is just that advertising and what we can do on that. But I think consumers see brokers in a more positive light, and it's just getting into sort of that unpaid media, whether it be, Rob's column, I'll pay him a compliment, in the Globe or online, or whether it's other things that we do. I mean, we're out there a lot, and people are asking us and doing things, whether it's special insert sections in papers, whether it is stuff online. We've got more online in terms of our own advertising and promotion, because, as Rob says, that's where people are these days. So. There's the two channels. There's the brokers themselves educating themselves, finding information to make themselves better, whether it's going to a seminar, whether it's reading information, and then there's the information to get to the borrower.
Jared?
My comment would be, again, I agree. I think part of the thing is, I agree with CAAMP doing a national thing on that side. I think our partnership with them as well on the provincial side to promote the broker in BC has been very good. I know we're trying to go from the MBABC to go more consumer direct, on that side of it. We've had a philosophy change, and I think every broker out there, what you have to do is, it really starts at a grassroots. If you're the broker sitting there, you got to go out into your own personal community and promote yourself, attend the community events, promote the use of a broker, get in the local papers, get whatever needs to be done to make sure that you're promoting that. And I think we're more on a national scale, we have to promote using a broker. What we're doing right now is we're promoting companies, not brokers, the use of a broker. And that's where the key aspect is. Why use a broker? It's just like the insurance agent commercials, right? Those are fantastic commercials, right? About using a general an agent for that part of it. So if we can try to get some sort of way of promoting just the broker directly to the consumer, I think we can actually increase.
I agree. I saw there's two aspects to that question. The first is, I'm very encouraged that consumers are going online and doing research, but I'm equally as encouraged that they're still choosing to contact a broker at the end of the day. And our sweet spot has been first-time homebuyers, over 40%. Market share with that, we're on par with the banks with first-time homebuyers, and those are the ones who are online doing the research. So it's good that they're going on and doing the research and then choosing to deal with an expert to facilitate the transaction. To me, I see that as a real positive, because they're becoming more informed themselves, and they're choosing not to complete the transaction on their own and go into the branch, but to facilitate the transaction through a mortgage expert, through a broker at the end of the day. The second part is this question that we'll probably debate it for years still to come, in terms of how do you get that message out from, and I think knowledge is important. The fact that our consumers are going online and doing the research means that they're knowledge seekers, that they're information seekers. And being in the media and a source of information, to me, is the most valuable place to be right now, in terms of dedicating resources to that, to being a source of knowledge. And we've got 16 to 18,000 feet on the street who should be that source of knowledge for this. You talk about a grassroots movement. It's up to the individual broker to get the message out. So when you combine online media with grassroots movements and knowledge, that's how I think we can move the needle.
Perfect. Well, I appreciate all of you gentlemen and your commentary today, and I thank everyone for tuning in, and hopefully we can put another panel together and have some of you in again. And thanks very much, everybody, and hope to see you next time.
Thank you.
Thank you.
Thanks.